Hello, hello, hello. My name is Troy White. I'm a portfolio manager, financial educator with Hoodoo Financial. Today, I'm covering a topic. I'm kind of altering it a little bit. What I wrote down was I wanted to cover the number one thing stopping African American investors from succeeding. But there is not really no number one thing. There's a grouping of things. So talking about one thing is kind of a fruitless effort. So, what I wanted to do was sort of change my statement a little bit and talk about the the key factors that prevent African Americans from creating a investing in the stock market, creating portfolios, and I we can go into the real estate aspects as well, but that's kind of a separate conversation. But the concepts are the same. What is it that is creating this wealth gap? Is the lack of investing on the part of African American population, investing in the stock market and investing in real property as well. So today we're just talking about the stock market. So those key factors, as I'm laying them out, are knowledge, technology, resources, and advice. And so, where are we going with this? I don't know, but I want to back up a little bit and tell you some things that I do know that you may not be aware of. So, how did we get in this current situation where the participation in the investment in the stock market is low on the part of African Americans? And first, I will highlight that it's not just African Americans. It's all of Americans, and in part because investment in the stock market is relatively new in relation to all Americans. Investing in the stock market was something that was elite. You had to have some money in the first place to even get out, and there are some technical issues as to why that was so. And as the technology changed, it opened the doors for new types of investing and new ways of investing. And current technological changes are even making it even better, and specifically for the African American population, but for everyone. But as we adopt these technological changes in relation to the investment finance and investment world, we get more participation in, but what has to come along with that is the knowledge. There's still a knowledge gap. And that's partially because the industry still is underrepresented from the employee standpoint. There are not as many African Americans in the financial services industry. And in fact, there are 8% of the financial services industry is is African American. Of that 8%, there is a portion, and I'm just picking a percent, say 2% of that 8%, 2% of that piece are client facing, meaning that they have the ability to face you like I'm facing you now and bring financial information to you and try to encourage you and ask you to come into the investment world. Because what you do with your investing dollars, if you do it in an intelligent way, benefits everyone in your community, whatever your community is. And if I'm talking to African American, then that means your African American community will be enhanced, improved by you becoming smarter, sharper, and investing your money and making more money. The better you become at investing, the more wealthier you will be. That will have a ripple effect throughout your entire community. All right. So, the reasons African American investors do not have stock market portfolios. So, to start off, because we don't have the knowledge, often Um, it's it's a kind of a scary thing. It's even a joke as to uh, not participating in the stock market. And to me, it's very similar to when I was a kid. It used to be popular to be dumber. So if you got a bad grade, you say, "Yeah, oh yeah, I flunked," or "Yeah, I got an F," "Yeah, I got a D," or something. Say it with pride. And that was something that it was in the inner city schools. It was pride in not being a brainiac. Well, currently, people have pride in not knowing the stock market. They have pride in not investing in the stock market. And they like to hear the bad news because that means since they're not participating, good. I want everybody to lose then. That's the gist of how I'm picking up the attitude from people who are not participating. And that's all wrong, and it's just all wrong because the problem is you don't know what you don't know, and your life could be greatly improved by digging in. So we're gonna just hit these four topics, and then we're gonna dive in, and I'm gonna show you some of the things that you can do in relation to these. And so, technology, the knowledge and advice, knowledge and advice kind of are going to come, they need to come to you from someone. And that someone is traditionally a financial advisor, an investment advisor, a financial planner, even a CPA or and often where what I notice is African Americans receive their financial knowledge and information is passed through like a mortgage broker. That seems to be the key interaction point when folks are trying to increase their net worth and things. We can talk about that some more as well. So I'm saying there needs to be improvement of the knowledge and the advice given and received. Uh, Resources. Um, you don't have the resources, whether that's the resources uh, to dig in and find the information, or the resources that you think the resources to invest with. We know that it takes money to make money, and there's a theme in our community that people adopt and unconsciously, and that is like who's the brokest, and that'll have you just on a regular conversation. Oh yeah, man, it's hard out here. Oh yeah, I'm just trying to survive. Oh yeah, yeah, I'm trying to pay these bills, man. Oh yeah, this happened and that happened. This bad news and that bad news, man. I'm just trying to, and so we get into those conversations with some certain people, and when you see those people, this is the lane that you're going to be in. Well, what I'm trying to tell you is that you need to improve your surroundings and the food that you intaking, and that food, that I'm saying, that mental food on what the intake that you're receiving, because those kind of conversations are having those too often will that'll train your subconscious to think that opportunities are not there. And the reason is I'm saying this because you have to have your mind dedicated to searching for opportunity. Because at our firm in particular, first thing I always hear, we all yeah, I would invest, but I don't have the money. And so the money, what is the money? The money in most people's mind is like maybe a $10,000 thing. It requires 10,000 or something like that. But these people uh, who come to mind that say those things, oh, yeah, I don't have money, I don't have money. Their weed habit is $25 a day, but you could have you can invest $25 a month in your investment account. There is no investment minimums. Send money to your account on a consistent basis. We're going to talk about that as well. Some of the things that you can do. So these are some of the reasons why African Americans are not building investment portfolios, whether that's real estate or stock market portfolios, but specifically the stock market. So let's address some of these issues right now. So if you're listening to me right now, I'm telling you, go to www.hoodoofinancial.com and we're going to solve all those problems for you. We'll build you a portfolio starting now. All right, let's talk about it. So the knowledge, first off, that is no longer an excuse because on YouTube, there's an endless stream of financial literacy. Financial knowledge is now available to you at your fingertips 24/7. Now, so go to my YouTube channel. If there's some issues you need to have me discuss, send it to me in a message and I'll talk about it. But the point is, the information is there. The knowledge will give you power, but it needs you to soak it up. You know, just having it be there is not enough. And with knowledge, the only thing is you're going to have to take some action. So you're going to need an account. So let's just start writing some things. So you're going to need an investment account. And so we're doing some little bit of financial planning right now. I'm just going to run down some of the things that you need to do right away to improve your life. If you are one of the African Americans who are being prevented from building a stock market portfolio, all right, this is what you need to do. So you can get an account anywhere. Come to our firm. We have investment accounts, retirement, traditional accounts, business accounts, investment club accounts, um, every account type that exists at the larger firms exist at our firm as well. So that's what I'm telling you. So so with that in mind, you are going to need a traditional investment account, non-retirement, and then you're going to need an IRA. AC stands for account, right? IRA account, and then you're going to want, and this not, you don't have to do all of these all at once. And then you're going to need a Roth IRA. And then we're going to have a portfolio, at least one, in each of these accounts. Now, when I say at least, we're matching your goals to a portfolio because your goals have certain risk tolerances to them and they are on a time horizon. There is a time frame in which you need to achieve. So we're going to target investments specifically to achieve that goal, whatever your goal is. And some of those goals are short term, some are medium, some are long term, and some are retirement. These are retirement accounts. So we're gonna invest into your traditional account for your non-retirement related goals. You want to buy a new house. You want to buy a new motorcycle. You want to buy a new car. You want to send your kids to college. You want to do all this. We got other account types that we may need, but one mainstay you need right here. This is just like a bank account, but it's an investment account. So, far as I won't even address bank accounts today. All right. And so, in your investment account, we are building portfolios to match goals. You're going to have, so let's hypothetically say we're going to put 3 portfolios in here. This portfolio is going to be a short term objectives. Your goals are short term. These are medium term and these are long term. And working with you individually will identify what's short, medium, and long term to you, you know. to everyone else is different. But fundamentally, within the next 5 years, within the next 5 to 10 years, and from 10 years beyond, and this is like 30 years. So let's say if you're 30 years old right now, then you retire at 67. So that will be 37 years away. So what you do in these two accounts, you're going to reap the rewards for that in 37 years. Actually, you're going to reap the rewards from doing this at the end of this year. The year you're doing it, you reaping rewards right away in terms of your taxes. It's helping you immensely by doing that. And entrepreneurship, if we talking tax, you do these here and you doing entrepreneurial endeavors. Now you click on agrees. All right. So inside your IRA, let's say you are 30 years old and you have 37 years until you retire. My prediction is that you will have excuse me, at least 4 more jobs before you retire. So if you got more jobs and you had all of those jobs for about 5 years, that's only 20 years right there. So you could have more, right? So if you have all of those jobs for 5 years, that means you got a 401k at each one of those. So when you get to retirement, and then you kind of old, and I mean you are old, and you are not as sharp, and you don't remember back all the time. You can be like, "Where is that 401k? What was that company I worked for?" So how you gonna get your money? And what's it been doing all this time? You ain't been paying attention to it. You letting your money sit under a rock somewhere. You don't know what's going on over there. No, get your money under your control and have somebody that you trust help you manage those assets. This is not money, it's investors' assets, it's stocks and bonds. And so that's why in here we're going to have portfolios built because of those other jobs that you had. We're going to roll over those 401ks into your IRA. So if you're going to have what we said it's likely that you're going to have 7 different career changes. But let's say you have 5 jobs, that's 5 401ks. This is your pot to roll those over into. And so we monitor your assets and we make sure that because you got a little bit at that 401k at that job, a little bit at that one and that one and that one and that one. But it's possible that you're under diversified or over diversified, or it turns out, you got 5 different 401ks, you got the same shit in each one of them. So you didn't benefit from none of the ups and downs of the market, none of the benefits over these whole 37 years. You ain't been watching it, you just been thinking your money is just gonna sit there and grow. And then when you look at, when you do the analysis and you look, you haven't even been been on target with the benchmark, meaning you could have just put your money on the S&P and did way better. And you might not know what I'm talking about right now, but if we were to, if you listen to me more and more and we discuss this one-on-one, you realize what I'm saying. It's you taking on risk for nothing. You dodging bullets, but you don't even need to be over there by them bullets. That's not even part of your job. Is what I'm saying. So it's like, why you keep taking this path? You could have just went the easy route over there to get to the same location. If you're gonna go this path, then this path that's more dangerous, you should be. This should have took you to heaven, to exalt you in some sort of way. But that's a different conversation. I'm taking it even deeper. So this is for your rollovers. So your 401ks go up in here, and your regular contributions as well. So you can contribute to your 401k and to your IRA. You can contribute right now up to 7 G's in your IRA, 19, I believe, over in your 401k, and it kind of phases out as you reach a certain income level. And so portfolio. Let me pause. What's a portfolio? My cousin asked me that one time. I'm always talking, yeah, we're gonna build you a portfolio, we're gonna do this, do this. And I just take it for granted. Everybody knows what that is, right? But well, a portfolio in this, in relation to the stock market, is just a collection of assets and grouped in a way to achieve some sort of investment goal you have. So you have a portfolio of stocks, meaning you got this stock, that 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 stock. You got all of those in one basket. And we could have multiple baskets within this account. Same with over here, same with over here. All right. And there are a lot of other account types that we can, I'll list some of the others as well. All right. So this is what we would do. Now, in terms of the knowledge, I mentioned go on YouTube and whatnot, but when you have an advisor, you need to pick someone who speaks your language, who can understand the, as financial planners, we have certain things that we have to read, we have to study, we have to understand basic principles, but there's a human element. There is behavioral finance. Financial literacy involves more than just the numbers and the products and the stats and the analysis, because we're dealing with humans. And it's referred to as an emotional market. The stock market go up and down on people's emotions. So it's important that the person you work with, you able to discuss. Um, they need to kind of understand your life and have a basic understanding of what makes you tick. And you need to be able to express your fears to them, because all of those things to me, to us financial service professionals, when you complaining about something, I hear dollar, it's a cash register going on. There's some way to alleviate those complaints to, and usually it's a fear based on something that traces back to some sort of dollar value somewhere. Some money can be spent somewhere to solve your problem. Now, money don't solve every problem, but money is part of every solution, period. So anyway, so that's just on the knowledge and advice part. Now the technology, you can go to an online firm. The thing there is, you need to understand about investing, and I don't want to advertise for them, and I don't want to advertise against them. I'm only telling you what our firm can do. So we have the technology for you to have your cell phone and have your account and monitor your account on your cell phone. And we want to set up for you automation. So our technology allows for certain levels of investor automation. So we build the portfolio with you. First of all, we're digital, and we are virtual, so we don't have to physically be in the office together anymore. Wherever you are, we're going to get on the internet and Zoom and Facebook Live, Facebook video, video chat, um, email, text, the whole gamut. We need to convey information back and forth between each other and documentation. And we don't have to be in the same room anymore. So technology allows that. When I first entered the industry, that was not possible. It was all about scheduling and people faking on me all the time. You can't get the husband and the wife to come from two opposite jobs on opposite ends of the bay to meet at the same location at the same time. Somebody gotta go pick up the kids. That whole thing is just too hard. So in terms of the technology allows us to build a portfolio for you because our technology gives you the ability to have fractional shares of stocks, and that's how we build your portfolio. So if you're, let's say in this scenario, in the Roth IRA are after tax dollars, so that in retirement that's tax free. I'm not going to go too deep into that. But let's say also we got a custodial account for your kid, and this is saving some money for your kid. And then let's say uh, you have, I'm gonna just say that right there. You just got this is your starter kit, start investing. But the real thing is for you to say, here's the holy grail. How much are you going to invest? And everybody thinks they don't have enough. Oh, I don't. People, somebody might say, I only got about $1,000 a month that I could, invest, and they think that's not enough. And then someone else will say, I only got $25, and they think that's not enough. Not enough. Don't please me. Please you. Understand that we need to do the maximum amount that you can. But the maximum amount that you can doesn't mean emptying out your pocket into your investment account because that will ruin the investments. If you only have $100 left at the end of the month, don't tell me you can invest $100 because you can't. Because every month you're going to need to dip into your investments, and that means you're never going to invest. So if you only have $100 at the end of the month, then you probably only need to invest $25, maybe 50, maybe. But so let's say you're this person, and then you tell me you got every month you're gonna only have $250 that you can invest. And then you know what? On this one, I'm gonna say times two because you got two kids. So, and we could have a 529 actually for them as well. A 529 is a college savings account, it's a college savings plan. And we got that times two. So with the 529, that allows you to save for your kids' college. Stats show that when a child knows that they have something saved for college, they go to college. I didn't say have it all saved. Something, meaning that they've heard, oh, I got it's $600 in there for me to go. Well, college costs 60,000. That $600 ain't nothing, but it got them on the path. They know, oh, I got to go to college. It's some money saved for me. We'll get the 60,000 from somewhere, but this is to help get them there. And it's possible you may be able to, I mean, based on your income and how well the investments do, we may be able to pay for college just by investing in your 529. All right, so you told me you got $250. So how would I invest this if this is your life? You got two kids, you got a short-term goal that you need to achieve in 5 years, a medium-term goal 5 and 10 years, a long-term goal that's 10 years out. We know you got to retire, and you got you've rolled over three 401ks already into this. You're currently at a job where you paying into a 401k and they matching you. You don't have nothing in your Roth right now. What would you do with the $250? All right, one, two, three, four, five, six, seven. So that's the first easy thing I'm finna do is what's 250 divided by 7, right? So that's $35. So if I was just go evenly split, that would be $35. But I'm not gonna do that. What I want to do is 50 here and 50 here, right off the bat. That's for the kids, right? So this is 25 times 2 because you got 2 kids. So 25 times 2. So, and so then, oh, I didn't dive in. I said that's what the 529 is. So we're saving for college. And then when college over, they got some money in a custodial account. This is a uniform gift to minors account. And we could talk about all the great, wonderful things that how we're going to do this and how we're going to build that up and what amazing things that you can do with it for your kid. Um, but just trust me, we need to do that. All right, so that's $100. So we got 150 left. I say you at your job, you currently have a 401k. You have already rolled over into this. So we got 150 more to go. I'm going to say we're going to do 25 here. And this is monthly. So now that's 125. We got another 125 to go. And so that we're not going to invest every month into your IRA because this is the same tax treatment as your 401k. Because if you only told me that, I'm just going based on this is the number that you just told me, and this is a scenario. So based on this, I'm going to say, okay, we are you investing at your job. That's the tax deferred treatment um, of your payroll. So in the 401k, so on your taxes is reducing uh, your taxable income already by doing that. And so when you leave that job, we're gonna roll that into here. So that's why we need this, but we're gonna make the monthly contribution over here to your Roth. Because since you already doing that pre-tax dollars at your job, after tax dollars, we're gonna do right here in your Roth. So I say we at 125 to go, and I'm gonna divide that right here. And the way I would have did that is I would go, I would go 50 for your short-term portfolio, and now I got 75 more, and so I'm gonna go 50 on your medium term. Oh, I can't. I only got. Oh yeah. Yeah, I got 100. Yeah, I had 75 more. So yeah, I'm gonna go 50 in there in that portfolio, and then we're gonna go 25 right there. So that's 125. That's 125. $250, and we're building you a portfolio. Now we're gonna do this. Now you let's just now these are all may have variations of returns. So we're always trying. So compound returns are the magic of investing. So what it is your returns make money on top of returns on top of returns on top of returns every year. So let's just take this 250. Remember, I said this person is 30 years old. So they have 37 years to retirement. Even though right here in this scenario, we said all of this is 5 years, it's 5 to 10. Let's just do a quick number to see in if you're 30 years old, in 37 years, you will be 67, which will be the start of retirement. Because we're going to do more than this. We're going to try to build you a passive income stream that will make you, because we're legacy investors. So we're trying to build you a passive income stream so that your assets will continue to generate income and build more assets that generate income, that build more assets that generate more income. So, all right, I digress. What I wanted to say is if you invested $250 per month from age 30 to retirement, which is 67, and you received an average, I'm going to say 7%. I haven't even done the calculation yet. 7% compound interest. 7% is easy to, I shouldn't say easy. There is no easy. 7% is a common rate of return that you would have received if you was just hardly doing it. If you didn't know what you was doing, you probably could get 7%. Don't screw up, meaning buy high and selling low. That's what most people end up doing because they don't know what they're doing. They don't know that that's actually what they're doing. Um, and we can talk about that at a later day too. But let's do the calculation. Let me see. The calculation of $250 is what I'm starting with. All right. I got $250 right now. I'm 30 years old. I'm going to invest $250 every month. And I'm saying that I'm going to be conservative and just say you receive 7% return. Now, understand that if you invested with me, when over all of these years, I want us to be achieving above 12%, above 10. I want to be hitting these like 25s on 25% returns. These great economies that we keep having. I want working together. I want to take advantage of these good economies. We don't know what the future holds, but I think it's going to hold more than 7%. So we're going to say 7. And 30 years is 360 months. So we're saying 37 more years. So 37 times 12 is 444 months. So how much money? I haven't even hit the calculate button yet. How much, what would be the value of your portfolio if you received an average return of 7% starting at age 30 until you retired at age 37, investing in the stock market, investing $250 a month? How much do you think you would have? You would have $527,443.57. That's what doing this will get for you. But there's there's ways we're gonna parlay that into something even bigger and better. Because along this route, as a legacy investor, as someone who is looking to take care of your kids and contribute to the ones who come behind them, is we're gonna have to build rental income. You're gonna have to have a real estate investment portfolio, not just a stock market portfolio. And you're going to be engaged in entrepreneurship. I don't care if you say, but I don't know about real estate. I don't care if you say, but I'm not a business person. Stop saying that. That's knowledge. As you learn, you grow. Period. Don't tell me what you not. Don't tell me what you ain't done. Don't tell me what you're scared about. I mean, you can tell me that, but that's just a problem that we have to solve. We have to inject that information into your brain and put the courage into your body so you stop being scared. Scared money ain't gonna make no money. A scared person ain't even gonna place a bet on themselves. And I'm saying bet on you. So doing these whole things, just doing the simple route, a small amount consistently, always will get you $527,443.57. But if we use that along the route to invest in real estate, specifically acquiring rental properties, as well as wholesaling properties, which makes you more money, as well as fixing and flipping, which makes you more money and gives you more experience and push you in line to receive more opportunities, and entrepreneurship. Those things I just named right here are a form of entrepreneurship. You know, entrepreneurship doesn't even mean that you have to be running a business. Entrepreneurship may mean you're a seed money investor. You put in on a business. Investment clubs, meaning investment clubs or investment groups. Investment club. Uh, you just need to be a participant. You don't have to run the investment clubs are involved in entrepreneurial endeavors. Investment clubs invest in real estate portfolios. Investment clubs invest in real estate that makes rental income, produces rental income that feeds back into the club. We need to take advantage of these things. You know, it goes deeper. These things work together, and it starts just like a watch. The the mechanism it operates together. Things run smooth when you put them all together. So that's just a little bit about the issues, the I call them the four things that prevent African Americans from building investment portfolios, and some of the considerations that you need to be aware of to get on board. And don't be a statistic. Don't be one of the don't knows. Be one of the do knows. And one of the ones who is on board. Do a little bit so that you can have a lot later. All right. Thanks for listening. And